name is Keith Singer. I'm here in Hollywood, Florida. Our main office is in Boca Raton, Florida. And we have an advisory firm called Singer Wealth Advisors. We specialize in alternative investments. Our thought process is that if you look at equity markets, the valuations are really, really high. And as we all know, we're in a historically low interest rate environment. So we're looking for other ways to make good returns besides just the traditional publicly traded stock and bond markets. And to that extent, we do quite a bit of work with private equity, private credit deals, private real estate. We're going to talk about structured notes. We even do some hard money loans for some clients. And we're always looking at new ways that we can help our clients make predictable returns with less risk than the stock market and more upside. So we're all about trying to create really, really good risk-adjusted returns. And for those of you who like equities, you're going to see that there's a way to invest and get the benefit of equities with a much more predefined outcome or range of outcomes than if you just invest directly in equities. So to that extent, let's start and we'll talk about what we can do with structured notes. Now here's the basic principles of structured notes. They're issued by major banks. So the banks right now that have a lot of activity in this marketplace are Goldman Sachs, TD Bank, Morgan Stanley, Barclays. We just did one with Bank of Montreal, PNB Paribas, Societe Generale. So the major banks are players in the space, and they can be designed to create growth or income. And what these banks do is they use derivatives of either stocks or indexes to create specified outcomes. And once they issue these notes, the banks don't have any risk. All the risk has been hedged by the options. And so we can design these notes to increase returns or reduce risk or a combination of those. And they typically last 1 to 5 years, or you can make them. I've seen them for 10 years as well. But typically most of the notes we're doing are 1 to 5 year notes. And so when I talk about increased returns or reduced risk, that's really up to our clients. We can design a note with way less risk and less upside, or we can design a note with less risk and a lot more upside. So it's really a question of the individual investor, what they consider to be risky and what their expected return outcomes are. So, all right, so let's talk about the risks of structured notes. We'll get that out of the way. Whenever you buy a structured note, you have the credit risk of the issuing bank. All right, if Goldman Sachs has solvency issues and you have one of their notes, you're going to be treated like a bondholder, right? So if they go bankrupt and they can't pay 100 cents on the dollar of their claims, you could lose money. So you absolutely have to be comfortable with the credit risk of whatever banks you're using. And if you're not, this would not be for you. But assuming you're comfortable that the major banks aren't going out of business, and I think we've seen so much of the federal government doing whatever they can to keep things running smoothly, it seems to me that the chance of a bank going out of business is more remote than it's ever been. There's also liquidity risk. Once you buy these notes, they do trade like a bond on the secondary market. However, there's no guarantee you'll get full price. In fact, a lot of these notes, if you do try to sell before maturity, oftentimes they trade at a discount to what they're really, really worth, what their intrinsic value is. So you might have to hold them to maturity to get the full value. Now, obviously, there's going to be the investment risk of the underlying securities. So if your underlying securities aren't doing well, you could potentially lose money on your note, depending on the terms. And then, obviously, if one of your notes is called, there's reinvestment risk. What are you going to do with that money if your note is called? There may not be a note that was as good as the one that you had bought once your note is called. So that's a risk, reinvestment risk. Now, there's two kinds of notes we're using. One is growth-oriented, and the growth ones don't provide any distribution on a quarterly basis or a monthly basis, but they're taxed generally as capital gains. And then there's income notes, which do produce annual income, and that income is generally taxed as interest income. Now, whenever you get a note, there's an offering, there's a document which would explain all the particulars of any given note. When we make notes, we want to go to all the banks and have them bid against each other, so we get the very best deal for our clients. We don't make any commissions on these notes. Whatever we get, we give to the client. And we charge a fee, and so we're on the same side as the client. We don't have any benefit by selling one note over another. And we want to negotiate on our client's behalf to create the very best terms for them. Okay, so let's talk about a hypothetical income note. Let's say we have a note that's paying 10% a year, or 2.5% per quarter. And the underlying security is the S&P 500 and the Dow Jones. And whatever does the worst is the one that you're tracking. So let's say the term's 15 months and it's callable by the issuer, and there's a 40% income and principal barrier. That means that as long as neither of these indexes are down more than 40%, you get your 10% a year. So for many people, they're comfortable taking that risk because it's very unlikely in any given 15 months that one of these indexes is going to be down 40% and not come back before the end of the time period. So there's a few different scenarios. Let's say you own one of these notes, and after the first quarter, both indexes are down, but not more than 40%. In that scenario, you make your 2.5% interest. Next quarter, one of the indexes is up, one of the indexes is negative, you still make your 2.5%. Third quarter, they're both up, then you make your 2.5% for the third quarter, but your note's called and you get your money back, 100% of your principal. So in that scenario, you made 7.5% on your money in 9 months. So now you have another scenario where first quarter, one index is up, one's down, you get your money. Next quarter, they're both down, but not 40%, so you get another 2.5%. Third quarter, one's almost down 40%, but not quite, and the other is up, you get your interest. Next quarter, same thing, they're both down, you get your interest. And then finally, after the note matures, they're both down, but neither of them are down more than 40%. So you made 12.5% in 15 months. Even though both indexes, maybe one's down 10, one's down 20 or 30, the market was horrible, but you still made 12.5%, even though the market did very, very poorly. Now, clearly, had you just invested in equities, you would have lost money. You would have not made money. So now here's another scenario. Yes.
Just point of clarification. This is an income note. So independent of the duration, it's still interesting.
It's kicking off its income every quarter or month, depending on the note. Okay. So now next scenario, everything's the same except after the fourth quarter, one of the indexes was down more than 40%. You don't get interest that quarter. And then let's say at the end of a year and a half later, although it was down 44% at one point, by the time the note matured, it was only down 38%. You get your full principal back. Plus you made 10% over 15 months. So this is like a pretty safe way to make a predefined rate of return. So how safe is it? Well, let's look at the S&P 500. According to Bloomberg, if you go and you look at all the rolling periods of the S&P 500, it's in any 12 months, it's down less than 10%, 90% of the time, okay? And it's down in any 12 months more than 40%, less than 1%, right? So in any 12 months, the S&P is going to be down less than 40%, 0.7% of the time. So what's interesting is that the longer your note is before it matures, the less risk you have of the note still being down. Because as we saw in 2020, the S&P was down 30, but a few months later, it wasn't down at all anymore. And it had come back. So in this scenario, if you look at a note for 4 years on the S&P 500 and a 40% barrier, it's down more than 40% 4 years later, about less than 1 in 1,000 times. Okay. So for us and a lot of our investors, they're very comfortable with a 1 in 1,000 chance that they could lose principal. So obviously, if you said, you know what, I'm comfortable with a a 30% barrier in 2 years. Now you have a 95% chance of not losing. And so you'll make more interest if you take more risk, right? So the longer the term is and the bigger the barrier is, the less interest you get. So let's give you an example of some of the notes we've done recently. Here's a Russell, S&P, and Dow Jones, 8.5% 5-year note. It gets paid quarterly. It's got a 40% barrier. So when you see it says 60% barrier, that means that it has to be down less. The original index has to be within 60% of where it started, which means it can go down 40% without you losing money. So in this scenario, we were able to get our clients 8.5% for 5 years, and this can't be called for at least 6 months. And so even if the indexes are down, they're still making 8.5. And there's probably a 1 in 1,000 chance, at least based on history, that one of these indexes will be down more than 40% after 5 years from today. So to us, that's very, very compelling, very attractive. We like the ones that obviously have as little risk as possible. Now, here's an example of a digital note. These pay out only at maturity, and therefore, if it's held for a year, which these are because it can't be called for at least a year, the gains will be capital gains. Okay, so we can look at a basket of stocks, and we can go to the banks and say, okay, let's look at DocuSign, Bank of America, Twilio, and Spotify. I'm comfortable none of them are going to go down 50% this year. What will you pay me? If none of them go down 50%, you're going to make 9% for 1 year in a capital gain, long term. And say, well, what are some other stocks? So what if we do Lululemon, Pinterest, American Express, and Facebook? If you do those 4 stocks and none of them go down 50%, you make 13%. Now, if you want to be more aggressive and you only want a 40% barrier, you can get 22.5% with a 40% barrier. So if you like those stocks anyway, if you like Lululemon and you like, American Express and Facebook, and you like that basket of stocks, but you're not sure we're going to have a good year in the stock market, and you rather would just make 22.75, even if all those stocks are down 10, 20, 30, 40%, you're still making your 22.75. And if they were all up 30, 40, you only made 22.75, right? So obviously the risk of loss is less because even if they're down a good amount, you don't lose anything. You still make your 22.75. So these are the kinds of notes, if you want to be more aggressive, I would look at them more as like an equity replacement, because if you like these stocks and you were thinking of owning them in your portfolio, you could say, you know what, let me just make 22.75 as long as they don't go down 40%.
Keith?
Yes.
Would you mind going back to the example of the 15-year note in this where it went down 40% and you lost the coupon for a month?
Yeah, 15-month note. That's a 15-month note. So in that scenario, if one of the indexes was down, this is an income note. So income notes have if you breach the barrier, you don't get a coupon that month. Some income notes have memory, which means that subsequently, if next quarter closes above the barrier, you'll make up missed coupons. This one doesn't.
So it's like a catch up.
Yeah.
So if it went below 40%, as it did in that month, you lose the coupon.
Right.
And then it came back up, and so you got the coupon again, and then the note matured.
Right.
If it went below 40%, went up, and then went back down below 40 before it matured.
Yes.
That's
so at the end of the quarter, if it closed and the note was below the barrier, it was down 42%, you will only get 68 or 58% of your money back. Okay. Now you made 10% along the way in interest. And if you were going to invest in the market anyway, you could then take those proceeds and buy the index and wait for it to come back, or you could just take your loss, right?
But as long as it closes at the end of the term above the barrier,
right, then you're good. You get all your money back. So in this scenario, it looks like it's both indexes are down quite a bit, close to like maybe 35%. You get all your money back. Now, like we said, the longer the note is, the higher the likelihood that indexes recover and they're not down 40% anymore, right? So we generally, on an index note are doing 4 years or 5 years, which reduces your chances of it being below the barrier to like 1 in 1,000.
Yep, makes sense. Thank you.
Yeah. So, and again, these are the charts. This shows you that 4-year period with the S&P down more than 40% after 48 months has happened. Basically, 1 out of 1,000. And then after 5 years, it happened less than 0.5%, half of 1 out of 1,000. And then if you do a 50%, 3 years, the index has never been down 50% 3 years later. So if you really like to be more conservative, but when you do 50% for 3 years, you're going to get less interest. Okay, so here's another note we did. If you like blue chips and you just want to make 10%, Apple, Amazon, Facebook, Microsoft, 3-year note. If none of them are down more than 50%, you make your 10% a year. And at the end of 3 years, if none of them are down 50%, you get your money back. Now this one has a 1 star, which means that even, let's say Facebook is down 52%, but Apple's up 1% or more. If one of the stocks is up, you're going to get your money back. So it provides an extra layer of safety by having the 1 star feature. So when you're using individual stocks and you have a 1 star feature, one could be really bad or all 3 could be really bad. But if even one of them, if Amazon's positive in 3 years, your note will mature at face value, even if all other stocks are down more than 50%. So we just launched this one, and you know, people are pretty happy making 10% with what they consider to be pretty low risk.
So up 1% from what?
From where the price was on the day the bond was issued.
Okay, great.
So here's another one we did for those with a little bit more appetite for risk. Although I'm going to qualify that remark because this one has a 28.8% coupon. It's Tesla, you know, AMD and Zoom, and it's paying 28.8% a year, or, you know, over 7% a quarter, 7.2% a quarter. So this has an 80% call barrier. So we issued this on November 2nd. This will probably get called because the market's been up since November 2nd. But if none of the stocks are down 20% after 3 months, it's getting called. And we did that intentionally because, you know, it makes it less risky. Because if one of the stocks is down 18%, it could be on its way to down more than that. So if you get called, as long as none of the stocks are down 20 the first quarter, or even any quarter after that, then, you know, you get your money back and you made 7.2% in 3 months. Okay, so this has a 50% principal barrier. So if none of the stocks were down 50, but let's say you made 28.8% the first year and then 28.8% the second year, and then 3 years later, Zoom was down 54%, right? So you made, you know, you lost 54% of your principal, but you gained 56% of your money in interest along the way. So having a large coupon mitigates your risk of loss, because within you know, 2 years, you're already covered the first 56% of potential losses. So these are interesting. You know, I will tell you that when the market's more volatile, like it has been, you probably get better notes. In a calm market, it's probably less sexy, some of these notes. So let's talk about the practical use of income notes, either as an equity replacement with a predetermined outcome, or as an alternative income source, right? So you might say, you know what, there's been decades where the stock market's been negative for 10 years, right? I'd be happy doing 10% notes and 12% notes and maybe sprinkling a 28% note and try to build a portfolio where I can make 12% a year, right? Where, you know, it might be that the market did 15, but I'm happy with 12, right? So instead of investing in equities, you can, you know, create a predetermined outcome with high coupons. And then obviously, if you need income, this is an alternative income source. Okay, it's an income source that you can get every quarter and spend, and, you know, it's hard to make income right now. So, treasuries are pretty low, corporate bonds are pretty low. So this is a pretty attractive income source. Okay, let's talk about growth notes. Some of us invest for income, some of us for growth, some invest for both. Okay, there's 4 components to a growth note. There's a barrier or a buffer. So you're familiar with what a barrier is. We just went through that. A barrier means that if your underlying security breaches that barrier, you will have a loss for the full amount of the loss of the underlying security. A buffer is a little more safe. If you have a 20% buffer, the first 20% you don't lose, but after, if it does breach the buffer, and let's see if it's down 25% against your 20% buffer, you only lose the 5% extra. So the first 20 you don't lose no matter what, even if it breaches. With the barrier, if it breaches, you lose the whole amount. So a buffer will provide additional safety, but usually you're going to get less returns if you use a buffer. Underlying security could be a stock or a basket of stocks or some ETFs. And then you have the term. Growth notes are not callable. The issuer cannot call the growth notes. And then you have participation. You're either going to get less than the returns of the index or the stock, equal to, or in many cases greater, with downside risk as well. So that's where it gets kind of exciting. So let's say you're a conservative investor. We had a buffer note we did for some clients when the markets were very, very scary. We used the S&P 500 as the underlying security, and we created a 25% buffer and 110% participation. So that means is at the end of 5 years, whatever the S&P 500 got, our clients are going to get 110% of those gains. If the S&P is down 20%, they'll get their money back. If the S&P 500 is down 30%, they're going to lose 5%. So you see there's much less investment risk with pretty much the same upside as the S&P 500. And now, although this doesn't have dividends, you don't get dividends with this. If you think about it, most people who try to reduce risk do so by adding asset classes like bonds or cash into their portfolio. And if you know you have a 25% buffer, you don't have to do that. So if you can get the same returns of the S&P 500, you can have a greater percentage of your assets allocated to that potential upside, knowing that you have that downside protection. So to me, I think that's much safer than having bonds in your portfolio, because bonds right now could actually go down themselves. And obviously the stock portion of your portfolio can go down as well. So in 5 years, it's unlikely that you're going to be down more than 25%. But if you are, you only lose the excess above what the buffer is in this particular note. So let's show you another application. Let's say you want to have exposure to cybersecurity in your portfolio. And we manage money for clients, and we do have ETFs that track cybersecurity, right? So the 2 leading ETFs are cyber and hack. If you look at them historically, their returns are almost identical. There's almost 100% correlation. So in this scenario, if you want to get a little more safety, you can look at a 5-year note, and there's a 30% barrier protection. So at the end of 5 years, if these indexes are down less than 30, but down 20 or 10, you don't lose anything. But if they're up, you get 135% of the gains. Now, if your alternative is really to own the equity and you want to get more leverage, you can have a 20% barrier and have 145% participation, which means at the end of 5 years, if hack was up 100% and cyber was up 102%, you're going to make 145% on your money, versus had you just owned hack, you're going to make 100%. So this is a way to get alpha, increase your returns, and actually decrease your investment risk, because in the remote chance that in 5 years, these indexes haven't done anything or down 10 or 15%, you wouldn't lose. Now, if they were down 30%, you're going to lose just the same as if you owned the index. So if you're going to own the ETF anyway, why not own it with the chance to make 45% more than the actual ETF makes? Okay, so let's talk about some other growth notes. One of the things we're most proud of is in late March, a lot of clients were scared and they were looking for ways to potentially take less risk, and they had equity portfolios with us. So we sold some of their equity ETFs, and we bought a 4-year growth note from Citibank that has a 30% barrier, but 163% participation between the S&P 500 and the Dow, whichever does worse. Okay, so we were giving them both additional security by knowing they had now had an additional 30% barrier. Remember, March was scary. We didn't know the Fed was going to come in. We didn't know, that this was going to get under control with COVID, if there was going to be a vaccine. And so it was a very, very scary time. And so here's what that note looks like today. At the bottom of the screen, the Dow Jones, since we bought that note, is up 49%, and the S&P 500 is up 53%. So the note is currently trading for 64% more than we paid because it has that leverage. Right now, the intrinsic value of this note, if you applied the full 63% additional gain that you're going to get, is really about 180%, up 80%. Right? It's really worth 80% more than what we paid. But the traded value, if you wanted to sell it today, it's up 64%. Even though the lesser index is only up 49%, because whoever buys it knows they're getting 63% more gains than whatever the lower index is. So that is a way, as you can see, to both reduce risk and increase expected return. And that's the name of the game in all your investments. You want as little risk as possible with as much upside possibility.
So Keith, what would you do with that note if you owned it right now?
What's great about it is, I have people asking me, should we sell it? I'm nervous. I'm like, look, if we sell it, we're not going to get the full value. We're not going to get the full leverage. You should hold that note. And invariably, it's gone higher and it's gone higher and it's gone higher. And that actually helps people not make decisions, rash decisions. Some people ask me, this is up a lot, we should take a profit. And look, we're long-term investors. If we cash it out, what are we going to do with it? Right? So
part of it's not to be able to replicate that note, right?
Yeah, and we had notes where we did 200% leverage. It just was the timing of it, whatever the time was going on. We had an income note. It was supposed to be like 12, 13%, and the volatility spiked so much that day that it actually was a 27% note, even though the issuer told it was going to be 11. They give us the offering documents, make them give us the actual income that's generated by the transaction. They called it after 3 months, but we still made 7% or over 7% in 3 months.
Keith, would it be okay to take a question?
Sure.
So our friend Michael wants to know who structures the notes and how frequently are these put together?
It's on a daily basis. We work with the banks that are big players: Citibank, Barclays, Goldman Sachs, Morgan Stanley, PNB Paribas, Societe Generale, TD Bank. Those, they're gonna be subject to their credit, their credit risk. So these banks are all the major banks, and so the biggest risk is that these banks have to be solvent when the note matures, so that you get your money.
So do you create them ad hoc, or do you create them when you have a budget to create one?
So you need $500,000 to create a note. Otherwise, the banks put out off-the-shelf offerings, which usually aren't as good. So we have clients, when we want to make a note, we'll just take, we might have one client that wants their own note for $1 million, and then we tell other clients, oh, you want to jump onto this? Give us whatever you want. There's also other advisors that are in our community that they launch a note and they let us know if we want to jump on. We can put clients in it. So once the bank is issuing it, we just have to tell them, they don't care if it's 500,000 or 5 million. They just want to know how much to do. And so when they're doing it, they have to lock in. You have to sort of lock an amount in, and if market conditions don't change, they may let you add on after the fact before they issue it. Or they may say, this is closed. The conditions have changed. We can't add on to this. But, the key is to try to find, compelling notes with good indexes or good stocks. Like, one I just did, one that was happening today is Moderna. And it just got launched today. It's paying 24% interest. It's an 18-month note with a 50% barrier. So if you like Moderna, and you think Moderna is going to do well, and you would rather just take 24% a year, even if it doesn't go up, or even if it's down 20, 30%, you could do that, instead of buying Moderna. And it's got a 20% call barrier. So after the first quarter, it'll probably get called. If it's not down 20% or more, it'll get called. So it'll probably wind up 3 months netting you 6% for 3 months.
And
So
what are is it seemingly obvious, or is it the obvious reason why they call them? Is that, if they don't call them, then they're going to be, paying out more than they would anticipate paying out.
some are auto callable. So that means they're getting called no matter what. Some it's up to the issuer it's up to their discretion. I honestly am not sure what motivates them, because I've seen them not call bonds where all the indexes are up, but 90% of the time they do call them if the indexes are up. So there must be some financial incentive for them to do that. Now, again, the banks have no risk. They don't care what the underlying securities do. They've already hedged the transaction from the beginning. It's all the options that are hedging it.
And so why would a bank do this?
They make like 10 basis points on issuing it.
So they're just using their balance sheet.
Right. Yeah. Mm-hmm. So, if a bank, if Goldman Sachs had bonds that were paying 3%, right? Instead of paying that 3% interest out, they're using that 3% to buy the derivatives, calls and swaps, and they're creating these outcomes. And then they're selling them, and they're just making their little bit of upfront money. And really, when markets are more volatile, they can do more dramatic things. When there's less volatility, we're noticing right now, notes that were paying 12, 13% 3 months ago are now paying like 8 on reissue, because there's less volatility than there was. But there's always going to be spikes in volatility here and there, and I just had a note call today. It was 30% on Tesla, and I made 7.5% for 3 months, and it got called. Now, if I owned Tesla, I would have made 50%, but I also could have lost. So
yeah.
So let me see what else. So we have a note list. If anybody wants to get on, we can email you our notes that we have. You can take a look at them. You text the word profits to 474747. We can call our office at 561-998-9985. And we can show you the notes that we have, that we're offering, that we have at our disposal. And when we issue new ones, you can know about them. And if you want to own any of them, or you want to talk to us about building a portfolio for you of these notes, either for growth or for income, give us a call, and we'd be happy to do that for you. So anyone have any questions?
So there's some questions coming in. Thank you, Keith. That was super helpful. So what do you see? Maybe there isn't a trend to identify, but do you see people reacting to your list of notes that are available more
Yes.
so than saying, okay, go create this note because I want to express an opinion?
Well, a lot of times people see notes and they're very compelling, and we just had one against Wynn, right? If you think there's going to be the Las Vegas casino, it was trading at 96. It's got a 15% coupon if it doesn't go down 50%. Wynn was, even if Wynn would have to go down below where it was in March for, you to lose money, And so if you think like we're coming out of this and we're going to get a vaccine and things are going to get better, that can be very, very compelling. And it's a one-time thing. Like, it's either now or never. Like, in a week, that note might be completely different. The price of the underlying stock could be different. So when these things pop up, we only get notice of them if they're not ours. It might be a week to 3 days, a day to 3 days before they get issued, right? So sometimes if you want them, you have to act fast, or you wait for the next one. But there's not going to be an identical next one. It'll be something else.
Right. So from a practical perspective, one has to open up an account, make sure there's
we use Schwab as our
custodian to wire money so you can execute the trade in a timely fashion.
Yeah, we use Schwab as our custodian. If you do buy a note, you get 2 days to wire the money.
Yeah.
But on the first transaction, if I don't know you, I'm taking a chance.
Yeah. Yeah. No, that's totally, yeah. Yeah. From a practical perspective, it's probably wise to have, ready money, or at least some place to wire money to right away so you can execute.
Exactly. For
Right.
sure.
Yeah.
Mhm.
So, do you want to talk about a little bit more about if there is any trends that you're seeing in terms of whether the appetite for these notes in the banks is increasing, decreasing, or is it pretty constant?
I think it's been a super underutilized tool. I don't think a lot of people are aware of all the things you can do with them, both from growth and income. Um, I only really started I only opened my eyes to them maybe like a year and a half ago. And if I could go back, I would do a lot more of these because they were really phenomenal. And the next time there's a big sharp correction, we'll probably transfer more money from direct assets to these leverage notes to try to take advantage of a rebound, right? It's interesting. If you are already fully invested and you don't have a lot of dry powder, it's usually impossible to take advantage of the rebound, right? But with these notes, you could convert your stock, take a loss, and own notes, and now get 60 or 70% of the upside more than what it actually goes up. So the next time there's a big, I wish I had done more of notes, more of that for a bigger percentage of our assets. That Citibank note I showed you when the market had, got towards the bottom, because it's usually impossible to take advantage of a rebound if you've already been invested and rode the market down. And this is one way to do that. So, and then, the notes really, depends on the different stocks that you're looking at. Tesla seems to have a lot of volatility. So you're seeing really interesting notes on Tesla. At this point, I don't know if I'd be necessarily looking to use Tesla notes necessarily. But I'm probably looking at things that are more going to benefit as we get out of the economy, as we get out of COVID and our economy recovers. The stocks that have lagged are probably the ones that you want to be looking at with some of these notes, because they don't have nearly as much downside as some of the high flying internet stocks that have gone up so much. And when you're doing income notes, we don't need the stocks to make a lot. We just need them not to lose a lot.
Yeah, it seems like, aside from the risk that you clearly disclosed, that taking bond money and putting it in this, especially with how lame the bond returns have been,
Right.
Aside from the liquidity issue, right? If you're going to stay in the bonds anyway, so why not?
Yeah, absolutely. Let me see, there's some disclosures I have to show.
Yeah.
But yeah, so when you have bond, I don't know if I'd say take your bond money, your conservative money is your conservative.
Is my opinion. So let's just be clear on the matter of record, not yours.
The conservative money is conservative money. So obviously, everyone needs to consult their advisor before they make decisions and understand the tax consequences and make sure that it's overall consistent and suitable with what you're trying to do. But, these are very attractive risk-adjusted returns, in my opinion. I think that when you look at some of the opportunities, it's pretty compelling. In order to make market returns, usually you need to take market risk. But there's a way I just showed you to make full market returns with substantially less risk of loss using a buffer, right? I showed 110% with a 25% buffer. Think about that. If you want to have less than 100% market risk, what do you need to do normally? Add bonds in your portfolio, add cash in your portfolio, accept less return on 30, 40, 50% of your portfolio. If the bonds are averaging 2% on half your portfolio and the stocks are averaging 10, right? Then, you're looking at a 6% return.
Yep.
That's if the market cooperates and gets 10. If we get a bad decade, you know, where the market goes down, then, you know, you could be losing.
Yeah.
With that buffer annuity, the buffer note I showed you, you know, you're pretty much not going to lose. Even if the market's down 26% in 5 years, you still only lose 1%. And if it's up, you make 110%. So you can be super conservative, or you can, you know, be a little less conservative, but still have less investment risk and have more upside than the market. You know, here's an example on the screen. Dow Jones is up 48.94. Our note's up 64, but it's really worth 80% more, right? Because you're not getting the full value of that leverage until maturity.
And so what, this is
less downside risk.
This is 6 months into the note.
Yeah, this is from March.
Yeah, March.
9 months.
A little bit more than 6 months. Very good. Super helpful. Would you like to, Keith, just have a closing remarks, and we'll wrap things up. And if there's any more questions, please send them along.
Yeah, if anybody wants to see the notes we can get for them, give us a call. We'll go back to the screen here. You can text the word profits to 474747. Give us your email. We'll get you on our list, or you can call our office at 561-998-9985.
Great. That's super helpful. Thank you, everybody, for joining in today. We'll make sure that Keith gets all your information and is in touch directly. And of course, you're welcome to text and join the list, and please do. That was very, very well done, Keith. I've seen a million of these things. Thank you for doing that. And as I mentioned, we're going to record this. It's been recorded, and we're going to put it on the YouTube channel. So if there's others that want to dig a little deeper and take a look, or you want to review it, you're certainly welcome to do so. It'll be up there in a couple days. And as always, thank you for spending the only thing you can't make more of, and that's your time with us today. Thank you, Keith. Until next time. Okay. Take care.
Bye.